Most people think they know the story of the Wall Street crash. America spent the 1920s drunk on easy money. Ordinary people borrowed recklessly to buy stocks. Prices climbed beyond reason. Then in October 1929, the market suddenly collapsed. Fortunes disappeared. Bankers supposedly jumped from windows, and the Great Depression began. It is one of the cleanest stories in American history. It is also dangerously incomplete. The crash was real. The losses were enormous. But the idea that a few terrible days on Wall Street single-handedly destroyed the American economy confuses the most dramatic event with the deeper crisis developing underneath it. To understand 1929, you have to begin before Black Thursday, before Black Tuesday, before panic filled the floor of the New York Stock Exchange. You have to begin with the economy of the 1920s itself. The decade is remembered as the Roaring Twenties for good reason. Industrial production expanded. Automobile ownership transformed American life. Radio entered millions of homes. Refrigerators, electrical appliances, and mass-produced consumer goods became symbols of modern prosperity. Factories became more efficient. Assembly line production pushed output higher. Corporate profits surged. America seemed to have discovered a new economic formula: produce more, consume more, invest more, and let prosperity reinforce itself forever. But the boom was far less evenly distributed than the popular image suggests. By 1929, according to the source account, the richest 1% of American families received nearly 1/4 of all pre-tax income. Corporate profits climbed dramatically during the decade. Worker productivity increased, but wages for many factory workers, miners, agricultural laborers, and lower-income families did not rise nearly as quickly. The economy was becoming better at producing goods than much of the population was becoming at buying them. That created a dangerous imbalance. Factories could manufacture automobiles, radios, furniture, and appliances in enormous quantities, but mass production required mass purchasing power. If income became too concentrated at the top, the majority of families could not keep absorbing everything industry produced. Credit helped conceal the problem. Installment plans allowed consumers to buy automobiles and appliances without paying the entire price immediately. Debt made middle-class consumption look stronger than household finances actually were. Families could temporarily spend more than their current income allowed. But debt did not eliminate the underlying weakness. It postponed it. And underneath the urban prosperity was another America that had barely experienced the boom at all: the countryside. American agriculture had been struggling for most of the decade. During the First World War, European agriculture had been badly disrupted. American farmers responded by producing more. They bought additional land, they purchased tractors and equipment, they borrowed to expand. Higher wartime crop prices made those investments seem reasonable. Then the war ended. European agricultural production recovered. International demand for American farm goods weakened. Crop prices fell. Farmers who had borrowed during the boom were left with debts that did not fall along with the value of what they produced. Many could no longer earn enough to comfortably service their loans. Land values declined. Foreclosures increased, and rural banks began failing. These failures rarely produced the headlines Wall Street would receive in 1929. They happened quietly, one small town at a time. But they were early evidence that the American financial system was more fragile than the prosperity narrative admitted. So the economic structure of the late 1920s already contained several weaknesses. Income was heavily concentrated. Farmers were in distress. Consumers were increasingly dependent on credit. Banks in rural areas were vulnerable, and industrial production was growing faster than the purchasing power of many households. Then Wall Street added leverage to the structure. Between 1921 and September 1929, the Dow Jones Industrial Average climbed from roughly 63 points to more than 380. A six-fold increase in less than a decade transformed stock ownership into a national obsession. Newspapers printed market quotations. Brokerage offices attracted crowds. Stories of ordinary people becoming rich through stocks spread across the country. The market began to feel less like a place for long-term investment and more like a machine for manufacturing wealth. Margin buying intensified that psychology. An investor did not necessarily need the full price of a stock purchase. Suppose someone wanted to buy $1,000 worth of shares. They might put down only $100 or $200. The brokerage house lent the rest. The stock itself served as collateral. If the price rose, the investor could earn an extraordinary return on a relatively small amount of personal money. Everyone seemed to benefit. The investor multiplied gains. The broker collected commissions and interest. Banks provided funds to brokers. Rising stock prices made the loans appear safe, but leverage works in both directions. If a stock purchased with borrowed money falls, the investor's losses are magnified, and if the decline becomes large enough, the broker demands additional cash, a margin call. If the investor cannot provide it, the broker sells the shares. When thousands of investors receive margin calls at once, forced selling pushes stock prices lower. Lower prices trigger more margin calls. Those calls trigger more forced sales. A market built on leverage can therefore become self-destructive. By the summer of 1929, broker loans had climbed to roughly $85 billion. The market increasingly depended on the assumption that prices would continue rising. Federal Reserve officials understood the danger. The speculative boom was not invisible to policymakers. During 1928, the Fed attempted to cool financial speculation. It raised its discount rate. It sold government securities, reducing reserves available within the banking system. The intention was to make credit more expensive and discourage speculative lending. But monetary tightening cannot be aimed perfectly at Wall Street. Higher interest rates also affect factories, construction companies, home buyers, retailers, businesses trying to finance inventories or expansion. By attacking speculation, the Federal Reserve also tightened financial conditions across the broader economy, and evidence of weakness began appearing before October. Industrial production peaked during the summer of 1929. Automobile sales weakened. Construction slowed. Other economic indicators began turning downward. The American economy was already moving toward recession before the famous crash occurred. That distinction matters. The stock market collapse did not strike an economy enjoying perfect health. It struck one whose foundations were already weakening. Then came September, on September 3, 1929. The Dow reached its famous peak near 381. Afterward, prices began drifting downward. At first, the decline did not look catastrophic. Markets rise and fall. There were selling waves followed by recoveries. Optimists remained convinced that the long bull market would resume. Then the decline accelerated. On October 23, stocks fell sharply. The next morning brought Black Thursday, October 24, 1929. From the opening bell, selling overwhelmed the market. Prices dropped rapidly. Trading volume exploded. The technology of the era made the panic even worse. There were no digital price feeds. Investors depended on ticker machines printing transactions onto narrow strips of paper. On ordinary days, the system worked. On Black Thursday, it could not keep pace. The ticker fell further and further behind actual trades. Investors around the country were making decisions using prices that might already be badly outdated. Nobody knew exactly where the market stood. That uncertainty became fuel for panic. By midday, nearly 13 million shares had traded in extraordinary volume for the time. The exchange floor descended into chaos. Telephone lines jammed. Messengers rushed between brokerage firms. Crowds gathered outside Wall Street. Rumors spread faster than accurate information. Then the banking establishment intervened. Senior financiers gathered at the offices of J.P. Morgan and Company. A group led by Thomas Lamont organized an effort to stabilize the market. Major banks pooled approximately $240 million and began placing highly visible buy orders in leading stocks. The strategy was psychological as much as financial. America's most powerful bankers wanted investors to see that they still had confidence in the market. It resembled the interventions J.P. Morgan had used during earlier financial panics. For a moment, it worked. Prices stabilized. The Dow finished the day only modestly below its previous close. The newspapers reported that the crisis might have passed. The banking system had stepped in. Confidence had been restored. The worst was supposedly over. Then the weekend arrived. Investors had time to calculate losses. Brokers sent margin calls. Families considered how much borrowed money they owed. People who had watched prices disappear behind a delayed ticker on Thursday imagined what might happen when trading resumed. Fear deepened. On Monday, October 28, the market collapsed again. The Dow fell almost 13% in a single session. This time, the bankers could not restore confidence, and on Tuesday, October 29th, panic became historic. Black Tuesday, more than 16 million shares changed hands. The ticker ran hours behind. Investors sold at almost any available price. Many did not even know what their shares were worth by the time orders were executed. The Dow fell another 12% in only 2 days. Roughly 1/4 of the market's value had vanished. The psychological damage was immense. The great bull market had broken. Leverage magnified losses. Fortunes disappeared on paper. Confidence collapsed, and yet this is where the familiar story becomes misleading. Because the stock market did not simply fall continuously from October 1929 into the depths of the Depression. After the initial crash, it recovered substantially. By the spring of 1930, the Dow had regained a significant portion of what it had lost. For investors watching the recovery, it was possible to believe that October had been a terrifying financial panic, but not the beginning of a decade-long economic catastrophe. That possibility is crucial. If Black Tuesday alone caused the Great Depression, then the market's recovery becomes difficult to explain. The crash damaged wealth, it frightened consumers, it shook business confidence, it exposed an over-leveraged financial system. But the United States still had choices. A severe recession did not automatically have to become a historic depression. The deeper disaster would emerge afterward, not simply from what Wall Street had done before the crash, but from what banks, policymakers, Congress, the Federal Reserve, and the international monetary system would do after it. October 1929 broke the illusion of permanent prosperity. What followed would determine whether that broken illusion became something far worse. By the spring of 1930, something strange had happened. The stock market had recovered a substantial share of what it lost during the panic of October 1929. That recovery is one of the most important facts in the entire story, because it destroys the simplest explanation of the Great Depression. If Black Tuesday alone had caused the catastrophe, then a significant market rebound should have produced at least some stabilization in the broader economy. Instead, conditions kept getting worse. The reason is that the crash was not the whole disaster. It was the opening act. What followed was a chain of banking failures, monetary contraction, protectionism, and rigid policy decisions that transformed a severe recession into something far more destructive. At the center of that failure was the Federal Reserve. In 1929, the Fed was still a relatively young institution. It had existed for only 16 years. Its officials were operating inside a financial world dominated by ideas inherited from the 19th century, especially the belief that maintaining the gold standard was essential to economic credibility. That belief would become catastrophic. Between 1929 and 1933, the American money supply contracted by roughly one-third. That number is difficult to overstate. When money disappears from an economy, everything becomes harder. Businesses struggle to borrow, consumers reduce spending. Farmers cannot obtain credit, debt becomes more burdensome. Prices fall, wages fall, and every failure makes the next one more likely. The Federal Reserve possessed tools that could have slowed this process. It could inject liquidity, it could buy securities, it could lend more aggressively to struggling banks, it could act as the lender of last resort. Instead, it largely failed to stop the contraction. Part of the reason was the gold standard. The dollar was legally tied to gold at a fixed rate of 20.27 per ounce. Federal Reserve officials feared that expanding the money supply too aggressively would encourage gold to leave the country and undermine confidence in the dollar. So the institution faced a choice: protect the gold value of the currency, or respond more aggressively to the collapsing domestic economy. Too often, it chose gold. Then the banks began to fail. In December 1930, the Bank of the United States collapsed. Despite its official-sounding name, it was a private commercial institution. Its failure affected hundreds of thousands of depositors and became the largest American bank collapse up to that point. There was no federal deposit insurance. If your bank failed, your savings could disappear with it. That transformed fear into action. Depositors rushed to withdraw cash from banks they suspected might be vulnerable. Banks, however, do not keep all deposited money sitting in vaults. They lend much of it out. So even institutions that might have survived under normal conditions could be destroyed by a sudden wave of withdrawals. A bank failed. People became frightened. They pulled money from another bank. That bank lost reserves. Credit tightened. Businesses failed. More loans went bad, more banks weakened. The process fed itself. Between 1929 and 1933, more than 5,000 American banks failed. As they disappeared, so did much of the credit structure supporting the economy. Farmers could not finance planting. Businesses could not cover payroll. Families could not borrow. Investment collapsed. The Federal Reserve had been created partly to prevent exactly this kind of cascading panic, but it did not respond forcefully enough. Decades later, that failure became one of the most important conclusions in modern economic history. Milton Friedman and Anna Schwartz argued that the Federal Reserve allowed what might have remained a serious recession to become a monetary catastrophe. In 2002, Ben Bernanke, then a Federal Reserve governor, publicly acknowledged the significance of that argument. The institution itself had come to accept that its failures during the early 1930s mattered enormously. But monetary contraction was not the only policy mistake. In June 1930, President Herbert Hoover signed the Smoot-Hawley Tariff into law. The idea behind the legislation sounded politically appealing: protect American farmers, protect American manufacturers, raise barriers against foreign competition while the economy was weakening. Instead, other countries retaliated. Canada imposed counter tariffs. European governments raised barriers of their own. International trade contracted dramatically. By the early 1930s, world commerce had fallen by roughly two-thirds from its 1929 level, according to the source account. The tariff debate is more complicated than a simple claim that Smoot-Hawley caused the Depression. Foreign trade represented only part of the American economy. Some economists therefore argue that monetary contraction was far more important. But Smoot-Hawley amplified existing weaknesses. American farmers already depended heavily on export markets. When those markets contracted, agricultural incomes fell further. Farmers defaulted. Rural banks suffered. Bank failures deepened the credit contraction. The tariff therefore interacted with the banking crisis instead of operating separately from it. That pattern appears again and again in the Depression. No single failure explains everything. Each failure made the others more dangerous. There's another famous part of the crash story that also falls apart under examination. The bankers supposedly jumping from Wall Street windows. The image is almost irresistible. Greedy financiers lose everything and throw themselves from skyscrapers while stunned pedestrians below dodge the bodies. It is powerful. It is also mostly mythology. Economist John Kenneth Galbraith examined the evidence and found that suicide statistics in the immediate aftermath of the crash did not show the epidemic later folklore imagined. New York medical officials at the time publicly challenged the rumors. There were suicides connected to financial losses, but there was no rain of bankers from Manhattan windows. The myth grew because newspapers loved dramatic stories. Humorists repeated them. Foreign papers exaggerated them. The image captured the emotional violence of the crash so perfectly that people remembered it as fact. Reality was less cinematic. And the popular belief that virtually every American was speculating in stocks is exaggerated too. Stock ownership had expanded during the 1920s, but according to the source account, only a small percentage of Americans directly owned shares in 1929. The broader population was devastated, not because every household lost money on Wall Street. They were devastated because the banking and credit systems collapsed afterward. That distinction is critical. Wall Street losses were concentrated. The Depression spread through the entire economy. And while most Americans suffered, some investors actually profited from the collapse. Joseph P. Kennedy became one of the most famous examples. He had made substantial money during the boom and pulled much of his wealth out before the worst of the crash. Stories later circulated that he knew the market had become irrational after receiving investment advice from a showshine boy. Whether that anecdote is literally true is uncertain. But Kennedy did understand that speculation had reached extraordinary levels. He also reportedly made money betting against falling stocks. Percy Rockefeller and other sophisticated investors were similarly positioned to benefit from declining prices. That does not mean the crash was secretly engineered. There is no need for a conspiracy to explain what happened. Markets contain winners and losers. People with more information, more liquidity, and less debt often survive crises better than people who are over-leveraged and desperate. Financial collapse can therefore become a mechanism for transferring assets toward those who still possess cash. The Depression soon became more than an American crisis. The gold standard transmitted the damage internationally. Under the system, countries experiencing gold outflows were expected to raise interest rates and restrict credit. In normal conditions, this was supposed to restore balance. During a global downturn, it forced weakened economies to tighten policy when they desperately needed relief. France complicated the problem by accumulating enormous gold reserves. Britain had already returned to gold in 1925 at an exchange rate that placed heavy pressure on its economy. By September 1931, Britain could no longer maintain the system. It abandoned gold. That decision sent shockwaves through international finance. Investors then questioned whether the United States might do the same. Gold began leaving America, and the Federal Reserve responded by raising interest rates. In the middle of a depression, the goal was to defend the dollar. The consequence was tighter credit in an economy already collapsing. Economic historian Barry Eichengreen later described the gold standard as a set of golden shackles. The phrase captures the central problem. Governments had built a monetary system designed to enforce discipline. Then, during an emergency, that discipline prevented them from responding flexibly. Countries that abandoned gold earlier generally had greater freedom to expand their money supplies and recover. Those that remained tied to it longer often suffered more deeply. The American government eventually changed direction, but not under Herbert Hoover. Hoover is often remembered as a president who did absolutely nothing while the country collapsed. That is not entirely accurate. His administration encouraged businesses to maintain wages. It supported public works. It created the Reconstruction Finance Corporation to provide emergency loans to banks, railroads, and other institutions. Federal intervention under Hoover was greater than the mythology of total inaction suggests. The real problem was scale and philosophy. The crisis was larger than the response. And some of Hoover's decisions actively worsened conditions. Smoot-Hawley damaged international trade. The Revenue Act of 1932 raised taxes while the economy was still severely depressed. The administration remained deeply influenced by the idea that government budgets should move toward balance even during crisis. Hoover was not doing nothing. He was trying to solve an unprecedented catastrophe using assumptions that belonged to an older economic world. By March 1933, that approach had clearly failed. Franklin Roosevelt entered office during a banking emergency. His administration moved immediately. Banks temporarily closed while federal authorities examined them. The United States moved away from the old gold standard constraints. The government created deposit insurance through the FDIC. New securities laws eventually produced the Securities and Exchange Commission. Public works programs put people back to work. Federal authority expanded dramatically. Not every New Deal program succeeded. The Depression did not disappear overnight, but the philosophy of government had changed. Washington would no longer simply wait for the financial system to repair itself. That brings us back to the most important misunderstanding about 1929. The stock market crash and the Great Depression were not the same event. The crash exposed weakness. It destroyed confidence. It erased enormous amounts of paper wealth. It undoubtedly damaged consumption and investment. But the market itself recovered substantially before the economy reached its worst point. What made the Depression historic was everything that came afterward. Banks failed. The money supply collapsed. Trade contracted. The gold standard restricted policy. Officials repeatedly reacted to crisis with measures that intensified it. The crash was survivable. The response was not. And that is why so many of the familiar images are misleading. The Depression was not caused because everyone in America became a stock speculator. Most Americans never owned shares. It was not defined by bankers jumping from windows. That was largely folklore. It did not arrive without warning. Economic weakness had appeared months before Black Tuesday, and it was not simply the punishment for greed. It was the consequence of a fragile economic structure meeting institutional failure. Extreme inequality mattered. Weak farm incomes mattered. Household debt mattered. Banking fragility mattered. Speculation mattered. But policy determined how those weaknesses interacted after the shock. That is the deeper lesson of 1929. Financial crashes are dramatic because they happen quickly. Depressions are more dangerous because they are built afterward. They emerge when panic meets weak institutions, when governments defend outdated rules, and when policymakers mistake preserving the old system for saving the economy. Black Tuesday became the symbol, but the symbol was never the whole story. The catastrophe came later, and much of it did not have to happen.